Hi, welcome to PM Tycoon. In this video, we're going to learn about weighted average cost of capital, which is also called as WACC. We will call this word WACC as WACC throughout this video. When we say WACC, we're talking about weighted average cost of capital. On the screen, you see here, we have many slides listed here. I'm going to give you this slide for download so that you can use it for personal reasons or personal purposes. However, let me quickly walk you through the overview of the WACC subject here. What you see on the screen is we're starting with the very basics. We will talk about what is WACC, why is it needed, where it is used, so on and so forth. And we'll do a complete breakdown of WACC, wherein we'll talk about the different types of capital we have, and what are the different types of costs that we can have for those types of capital. Okay. And then we'll talk about weighted average. I'll show you how to compute weighted average by a simple example. And using that simple example, we are going to compute the weighted average for our cost of capital. And that way we'll understand the subject in and out. We will understand the basics. We'll understand the complete breakdown of WACC. And with this knowledge together, we are going to derive this formula ourselves. Okay, you will learn that in a moment. And we'll also quickly talk about where all we can apply this WACC in real world situations. Okay, on the screen, I'll give you a quick glimpse of what are the different kind of slides you get here. I've written the script, but I'm not going to use it. I'm going to talk. I'm going to explain it in detail because I know what we need to talk, and it is difficult for me to follow the slide and explain it to you. But hold your horses until the end of this video, because I want to congratulate you for watching this video, because I know for sure you're going to be more smarter after watching this video, and I bet it. And how do you know? Unless you watch it, you won't know. So stick with me for half an hour and we'll be done with WACC subject, and you're going to get a complete grip on WACC. Okay, let's start with what is WACC. Everything in life, everything in life has a cost. Be it your relation, be it your friendship, be it anything. Everything has a cost. Do you agree with me or not? If you do not agree, please do comment and let me know why. But even for your relations, you have to spend time. The cost of managing that relationship is time. Or sometimes, buying gifts for your near and dear, which is also good. So everything in life has a cost. Okay, we're starting with life example, right? Similarly, if you are in business, business has a cost. Okay. What are the different costs in business? You have to set up your business, for which you have to incur cost. If you take loans, you have to pay interest rates on the loans, which is a cost. If you are having employees, you have to pay salaries to your employees. If you have to promote your product, if you have to make your product, you have a cost associated with it, right? So like life, we have a cost in business. Okay, so business needs capital. The word capital means the money that is invested in your business. Capital is nothing but money that has been invested in business. And the official term in finance world is capital. So what is the capital that has been invested in the company? Right? So you need money to invest in your business. Let's call it capital. So whenever we say capital, that means we're talking about money that we're investing in our business. So how can we get money for our company? Let's say we're setting up a company. So there are different ways we can get money to invest in our business, right? One is we can take a loan, which is also called as debt. One is we can break our company into multiple shares, and we can have a value associated with each share, and we can sell those shares, which means we're selling a part of the company to acquire capital to run the company. So the money that we acquired by selling the shares is called equity. Okay, so there are primarily two types of capital in our business. One is debt, one is equity. Okay, so as I said, everything has a cost. The capital that you acquire to run your business, which is either debt or equity, has a cost. And you may ask, how is there a cost on debt? You take debt on some interest rate. Let's say you are acquiring a loan from a bank. Let's say you're going to pay 5% per annum or 8% per annum, right? This 8% is the cost of your debt. And you may ask, what is the cost of equity then? We already have sold the shares. How are we incurring cost? This is a very good question. Park your question, because to compute the cost of equity, there are different models. It's a tricky situation. Okay, it's not a straightforward answer like saying this is the cost of equity. There are different models like CAPM, which is capital asset pricing model. There are different models like dividend discount model. There are other models like bond yield plus risk premium model. Majorly, this is used across the industry. More than 70% of the companies used CAPM model. And the good news is that I've already made a video on CAPM. You can watch after this video so that you will understand how the cost for equity is derived. Okay, whatever the number that you get for CAPM is going to be the cost for equity. Okay, dividend discount model, bond yield, risk premium model, we can ignore it for now. This is the subject for another video. However, I just want to tell that there are different techniques that are available for us to compute the cost of equity. Okay, now let me move on to the next slide. We started with WACC and we spoke about capital. We spoke about cost of capital. But what about WA? WA stands here for weighted average. We haven't spoken about it. Let me talk about weighted average here. Okay. For that, I'm going to take a simple example. Let's say I have a basket here. Okay. Pardon my drawing, but assume this is a basket that I have and I have fruits in it. And there are two types of fruits I have in my basket. One is apple, one is orange. Okay, I have 10 apples in my basket and 4 oranges in my basket. And the cost of each apple is $4. Let's assume the cost of apple is $4. I know it's expensive, but let it be, okay? And we have 4 oranges and the cost of each orange is $2. I'm using the word cost of each apple, cost of each orange. Now, I'm going to ask you one simple question. I want you to compute and tell me what is the average cost of each fruit in my basket. What is the cost of each fruit in my basket? Please pause and compute it. Okay, for people who say the cost of each fruit in my basket is going to be $3, trust me, I'm banging my head on the wall. This is not the right answer. You must have done just $4 plus $2 by 2. Okay, this is wrong. Most of you might not have done it, but whosoever is doing it, please listen to this subject that I'm going to teach right now. So for us to compute the cost of each fruit, what we need to do is first we need to understand how many different types of fruits we have in our basket. We have 2 types of fruits in our basket. One is apple plus orange. So how many apples we have? We have 10 apples. Let's take 10 into what is the cost of each apple? The cost of each apple is 4 plus we have 4 oranges into the cost of each orange is 2. Okay. Since we are asking to compute the average cost of each fruit, we have to take the total number of fruits that we have. The total number of fruits that we have is 10 apples plus 4 oranges. It makes 10 plus 4, which is 14. So if I compute this number, what I'm going to get is 40 plus 8 divided by 14, which gives me a number of around 3.43. So the cost of each fruit in my basket is going to be $3.43. I can compute the same number in a different way. What I've just done is I've taken 10 apples into $4 plus 4 oranges into $2 divided by 14, which is 10 apples plus 4 oranges, right? I can simplify this math. I can say 10 into 4 divided by 14 plus 4 into 2 divided by 14, and I also say 10 divided by 14 into 4. I'm just writing this as this. Likewise, I'm going to write this as 4 divided by 14 into 2. What I'm trying to do here is I'm just trying to do it in terms of percentages. So 10 out of 14, 10 by 14 is going to give me somewhere around 71.43%. I have done the math here on my calculator. So 71.43% into 4 plus 4 by 14 is going to give me 28.57%. 28.57% into 2. Now if I do this math in a single line, I'm also going to get the value as $3.43 if I do the math, right? Now if I add this one plus this one, it's going to be 100%. 71.43 plus 21.57 is going to be 100%. Okay, so there are two ways. In first model, we said 10 into 4 plus 4 into 2 by 14. That gave us 3.43 per fruit, or we said 71.43% into 4 plus 28.57% into 2. This also gave us 3.43. What we have just done is we have used our fruits as an example. This is the basket I'm trying to draw. We've taken our fruits as an example and we have computed weighted average cost of fruit. What we have done is we have computed weighted average cost of fruits. So we are going to use the same knowledge that we've learned here for calculating the weighted average cost of fruit for weighted average cost of capital. Okay, now I said in my fruits example, I have a basket, right? This is a basket, let's say. I'm going to replace my basket with company. And I said I have fruits here. I'm going to replace this word fruits with capital. And I said I have apples and oranges in my basket. I'm going to replace the word apple with equity. And I'm going to replace the word orange with debt. Now, here we said apples into the cost of apples, which was $4, right? Plus we said oranges, number of oranges into cost of oranges, $2 by apples plus oranges. Now, if I take this same example, what I'm going to derive is instead of apples, I'm going to write it as equity into, let's assume for a moment that 4% is our cost of equity. I'm saying 4% plus oranges is my debt into, let's assume 2% is the cost of debt divided by equity plus debt. Or I can write this particular thing as total capital. So what we have just derived is weighted average cost of capital. So you understand now in the word WACC. So in WCC, we just looked into weighted average. We also know what is cost of capital. We were able to derive our weighted average cost of capital. In a way, we have derived the formula to some extent. Okay, I'm saying to some extent. I'm going to talk about the different types of capitals we have. I said we have equity and we have debt, right? When we talk about debt, we have different types of debts. Like, we can take loan from a bank or loan from any other company. That is considered as debt. We can also issue bonds of our company. And for people who do not know what bonds are nothing but if you are acquiring money from the market instead of banks or instead of any other company, if you are issuing a bond is nothing but a kind of a promissory note that you're saying to the buyer of a bond that if you buy my bond, if you hold it for, let's say, 5 years, every year I'm going to give you 8% on the price of the bond. Let's say you sold the bond for $100 each bond. And if someone is holding it for 5 years, then they're going to get $8 for 5 years, which is $40. And at the end of the bond period, you're going to buy the bond and you're going to give him $100. For holding the bond for 5 years, you have just given him $8 per annum. So that's how companies also acquire money. Okay, this is called bonds. So when we say debt, companies can get debt in the form of loans. Companies can get it in the form of bonds. But what about equities? There are two types of equities. One is common equity. Common equity is nothing but when you break your companies into multiple shares, right? You have assigned a value to each share. Now, depending upon the number of shares you sold in the market, you received your equity. That is called common equity. But there is also again a different type of equity called preferred equity. Now, what's the difference between preferred equity and common equity? Preferred equity is nothing but they are not a part of common equity, first of all. Meaning the price that we have for common equity. Common equity is traded on your share market, right? Every day there is trading going on for companies. That's the share price of the stock. So common equity is nothing but a common share. But the price of the preferred equity is different than that of a common equity. The reason why is it is sold separately. You can get preferred equities of a company if a company is offering preferred equity, like a normal share that you buy from a broker or from the company directly. Okay. So why companies offer preferred equity when you have common equity? The reason preferred equity is that this has a maturity date, meaning it's like a bond which you're selling it in the market. You are saying instead of paying fixed percentage of return like interest, you're going to give them some fixed or some percentage of dividends, higher dividends. Okay, what are dividends? If you are making profits in the company, at the end of the year, you would divide your profits by the number of shares and you get what is the profit for each share. And from that profit, you can say this percentage of amount is I'm going to give out for all shareholders for holding the share of the company as a dividend. Here, instead of giving dividend for the common shareholder, you're going to give some extra dividend for preferred stakeholders. So that is why it is called preferred equity. However, the downside of holding preferred equity is it has a maturity date. It does not go up like the common equity stock goes up in the market. So the upside potential for the preferred equity stock to go up is very less. However, the pro side of holding preferred equity is you're going to get dividends, higher dividends than a normal equity shareholder. So there are risks and there are, benefits of holding preferred equity. Okay, I hope you understand the difference between preferred equity and common equity, right? Why I'm explaining preferred equity is because in our WACC formula, we have to use preferred equity. That's the reason I'm just trying to take some time out and explain preferred equity. Now, we spoke about cost of capital, right? Cost of capital for debt, cost of capital for equity. I said cost of equity is calculated using CAPM technique. And cost of debt is simple, straightforward. Whatever the percentage of interest that you're paying on your loans or whatever the percentage you're committed to your bondholders is the cost of debt. But what about cost of preferred equity? Preferred equity is nothing but whatever the dividends you're paying for preferred equity holders. That has to be divided by the share price of preferred equity. So dividend price divided by share price of preferred equity is going to give you the cost of preferred equity. Okay. I hope you've understood so far how to compute the weighted average and how to get the cost of debt, the cost of equity. I know this is CAPM. You have to watch CAPM video to know how to compute this because this is a little lengthy topic. I can't cover in this video. I just want to keep this video short. And cost of preferred equity. Now, we are going to use the same weighted average cost of capital in which we say equity into cost of equity plus debt into cost of debt divided by total capital. I'm going to use the same formula and I'm going to include preferred equity here. So WACC is going to be for me now, I'll start with debt into cost of debt plus preferred equity into cost of preferred equity plus equity into cost of equity divided by total capital. In a way, this is our formula. If you remember, in the fruits example, I have computed using percentage, right? Here we can do the same thing. If I take this number, debt divided by total capital, we get the debt percentage. Okay, into cost of debt plus same thing. I'm just going to take this and divide it by here. Preferred equity divided by total capital, I'm writing it as TC, into cost of preferred equity plus equity divided by total capital into cost of equity. Now for this is the weighted average of the debt. We can write this particular thing as WD into, we can write cost as rate of capital, okay, rate of debt, RD, plus we can write this as WP, which is weighted preferred equity, into rate of preferred equity, plus weight of equity into rate of equity. So this is our formula for WACC. This is how we derive WACC. So WACC, I'm going to rewrite it here. I hope you now know what each term is. W is the weight of debt. WP is the weight of preferred equity. WP is the weight of equity. However, I just need to tell you one more thing. All these things, right? The weighted average cost of capital is done after tax. After tax, meaning company earns profits, right? After the profits are earned, you have to pay taxes. Now, after the taxes are paid, that is when you're going to pay out the equity or the dividends, I would say. Dividends on preferred equity. And after tax is when you do your CAPM numbers for your cost of equity. But here, the rate of debt, this is tax deductible. This is tax deductible, meaning you would not pay taxes on this. But here you have to pay taxes. The rate of equity and the rate of preferred equity, you have to pay taxes. But the rate of debt, you don't pay taxes. For that reason, we have to slightly modify our formula. We are saying weight of debt into rate of debt into 1 minus T. What does this T stand for? T stands for tax. Let's say my company is paying 30% tax overall. Then I have to take this 30% as a tax here. So when we say 30%, we are talking about 30 divided by 100, which comes up to 0.3. Okay, so I can write this as my weighted debt into rate of debt, whatever percentage, 1 minus 0.3. It comes up to 0.7. So let me write it here. The ultimate and the final formula is going to be here weighted debt into rate of debt multiplied by 1 minus T. T is going to be the company's tax, whatever the tax it is. It could be 30%, it could be 40%, 42%. Okay, the total tax. So you are not paying tax on this. That's the reason we are removing tax. Okay. Now here, weighted preferred equity into rate of preferred equity plus weighted equity into rate of equity. I know I'm repeating it. The reason I'm repeating it is because you would remember. The more you listen to it, you would understand why I'm doing it. Okay. So this is the formula we have derived. You can go out and look out on Google. Now this formula doesn't scare you because you yourself can now derive it. Okay. I hope this was helpful so far. Now, the important question is, why do we need to compute WACC? I'm going to explain it in a different way now. What is WACC telling us? WACC is telling us what is going to be the cost on our capital that we acquire for the company. Let's say if my company is having a WACC percentage of 7, which means for every $100 that I take as a capital to run my business, I have to ensure that I'm at least earning $107. This tells us that anything that we do, we have to ensure that we are earning profits more than 7% after taxes. So if we are going to take up a new project, if we are going to get some investment from the market and take up a new project, then we have to ensure that the project is giving us returns which is at least greater than 7%. And where all it is used? It is used in something called capital budgeting techniques. In capital budgeting techniques, there is something called opportunity cost. This opportunity cost is also called as discounted cash flow. Now, they use WACC as a discounted cash flow number. I have made a video on capital budgeting techniques. It's a highly successful video. It's close to about 850,000 views. It's a highly successful video. It's half an hour video. I strongly recommend you should watch that video after this video because it's going to give you a complete understanding of how the business decisions are made, whether to invest in a project or not. This WACC and capital budgeting techniques go hand in glove. So please go ahead and watch that video. All right. Now, there are a couple of courses that I'm going to recommend. I'm going to post the link in the description of this video. Those are very professional courses. If you want to get into finance world, those courses can help you grow in your career by leaps and bounds. And also know this, finance professionals are the ones who get paid big bucks in the industries. Do look out for the courses that I'm recommending, and they are going to be really helpful. The amount that you're going to spend on them is going to be like your one-day salary if you get into a job. So do the math. And thank you so much for watching this video. I really appreciate the time that you spent here. And I'm going to start a CFA series. Please do keep a tab on my videos. For that, you need to subscribe. You need to turn the bell icon on. And I'm just trying to produce valuable content, which is helpful for the people, for the careers. And I would really appreciate if you do subscribe. This will help the channel grow. And please do share this video with your colleagues and friends. Thank you so much. Have a good day. Bye-bye.